Picture this scenario. You wake up tomorrow morning and check the news, only to discover that a market worth over $1 trillion just crashed overnight. Your mortgage payment just doubled. Your job disappeared. Your investment portfolio evaporated. And somehow, even the price of Bitcoin tanked alongside everything else. What market has this kind of power? Most people would guess the stock market. They'd be wrong. The answer is the bond market, and if you don't understand how bonds work, you're missing the most crucial piece of the financial puzzle that affects literally every aspect of your economic life. Welcome to Wallet Wisdom. This channel is all about helping you actually understand how money works, not just memorize headlines. And as we go, drop a comment if any of this surprises you. Let me start with a simple story that will change how you think about money forever. Imagine you have an incredible business idea. You've done the research, created a bulletproof plan, and you're bursting with energy to get started. There's just one problem. You're completely broke. What do? You find someone with money and make them a deal. You promise to pay back everything they lend you, plus a little extra for their trouble. That extra payment is called interest, and congratulations, you've just discovered the fundamental concept behind the entire global financial system. Now here's where it gets interesting. Companies borrow money all the time through this exact process. But did you know that governments do the same thing? When your government needs cash, they don't just print more money or raise taxes. They issue bonds, which are essentially IOUs sold to investors worldwide. The government becomes the borrower, and anyone who buys their bonds becomes the lender. But why do governments need to borrow money in the first place? Think about everything your government spends money on: roads, bridges, schools, hospitals, military, defense, social programs. These investments don't just cost money, they actually stimulate the entire economy by creating jobs and making citizens more productive. More productive citizens and businesses generate more tax revenue, which theoretically pays for these investments. Here's the shocking reality though. Governments consistently spend way more money than they collect in taxes. The difference between what they spend and what they earn is called the budget deficit. Every single year this happens, the total national debt grows larger. We're talking about mind-boggling numbers here. The United Kingdom's national debt currently sits at around 2.7 trillion pounds. The United States, a staggering $36.7 trillion and climbing every second. Where does all this extra money come from? The government borrows it from the public by selling bonds at regular auctions. These bonds are purchased by banks, insurance companies, pension funds, foreign governments, and everyday investors like you and me. People buy government bonds because they're considered among the safest investments on the planet. If major governments like the US or UK were to default on their debt, meaning they couldn't pay it back, we'd be looking at a complete collapse of the global financial system. At that point, we'd all have much bigger problems to worry about. Let me break down the key terms you need to understand. The principal is the original amount being borrowed or invested. The coupon is the annual interest payment expressed as a percentage. The maturity date tells you when the loan expires and you get your money back. The yield is the actual return you receive, and here's where it gets tricky. The yield can be different from the coupon because bond prices constantly fluctuate in the market. This is crucial to understand. While the coupon rate stays fixed, the bond's price changes based on supply and demand. When the price falls, the yield rises. When the price rises, the yield falls. It's an inverse relationship that drives the entire bond market. So how are these prices determined? Governments sell new bonds through treasury auctions on a regular schedule. The yield at these auctions depends entirely on how much demand exists for those bonds at that moment. This is called the primary market. Once these bonds are issued, they trade on the secondary market where investors constantly buy and sell based on their predictions about future interest rates, economic growth, and inflation. Think about it this way. The market interest rates are really just the yield that global bond investors are demanding right now based on their collective guess about what's going to happen in the future. If they think rates are going up, bond prices fall and yields rise. If they think rates are going down, bond prices rise and yields fall. Here's where the real drama begins. When market rates go up, the government's borrowing costs increase dramatically. Remember that $36.7 trillion US debt I mentioned? The government doesn't just have to pay that back, they have to pay it back with interest. Current interest payments alone cost around $3 billion per day. That's not a typo. $3 billion every single day just to service the debt. The situation gets even more complicated because much of this debt consists of short-term treasury bills that mature in 6, 12, or 18 months. The government constantly has to roll over this debt by issuing new bonds to pay off the old ones. As interest rates rise, more and more of the country's economic output gets consumed by debt payments, leaving less money for healthcare, infrastructure, education, and defense. This creates a vicious cycle. To maintain public services while paying increasing debt costs, governments borrow even more money, which compounds the problem for the future. It's like using one credit card to pay off another, except on a national scale. Now, here's how this affects your investments. Bonds represent a guaranteed return, assuming the government doesn't default. Stocks, on the other hand, are much riskier because they represent ownership in companies that can fail or lose value for countless reasons. When bond yields are high, investors face a choice between a guaranteed return and a risky stock investment. Many choose the safety of bonds, causing stock prices to fall. The interest rate on government bonds is called the risk-free rate because it's theoretically the safest investment available. The difference between expected stock returns and this risk-free rate is called the equity risk premium. When bond yields rise, this premium shrinks, making stocks less attractive relative to bonds. There's also a hierarchy within the bond market itself. Government bonds are considered safer than corporate bonds because companies can go bankrupt while governments typically cannot. When economic uncertainty increases, investors demand higher interest rates from corporate bonds to compensate for the additional risk. The gap between safe government bonds and risky corporate bonds is called the high yield spread. When this spread widens, it usually signals trouble ahead in the broader economy. The bond market doesn't just reflect economic conditions, it actively shapes them. Rising interest rates slow down economic growth by making borrowing more expensive for businesses and consumers. This affects everything from business expansion plans to home purchases, creating a ripple effect throughout the entire economy. Understanding bonds means understanding the invisible force that determines whether your mortgage rate goes up or down, whether companies can afford to hire new employees, whether your retirement savings will grow or shrink, and whether entire economies will boom or bust. The bond market is the puppet master pulling the strings of the global financial system, and now you know how those strings work. The next time someone talks about interest rates, government debt, or market volatility, you'll understand the deeper mechanics at play. You'll see beyond the surface headlines to the fundamental forces that shape our economic reality. Most importantly, you'll make better financial decisions because you understand the true relationship between risk, return, and the massive bond market that connects them all. If this video helped you finally see how the bond market really controls everything from mortgages to stocks, make sure you subscribe to Wallet Wisdom so you don't miss what's coming next. And I'd love to hear from you. What part of the bond market confused you the most before today? Drop it in the comments. I use your questions to shape future videos. Thanks for watching, and I'll see you in the next one.